Imagine waking up one morning looking at your bank account and realizing that the system has been watching not only the large movements of your money, but the ordinary movements too. Not just the big withdrawals, not just the wire transfers, not just the investment trades, every deposit, every withdrawal, every time money moves from one place to another. Now imagine that you are retired, you are living on a fixed income, you are managing your savings the same way you have managed them for years. You are not hiding money, you are not evading taxes, you are not doing anything clever or illegal. You are simply trying to live, pay bills, help your family, and protect what you earned over a lifetime. Then one day you learn that a number, one simple number, can put your account under review, create a report, trigger questions, or in the worst case freeze money you were counting on. That number is $10,000. And in 2026, that number matters more than most people realize. The important thing to understand is that this is not just a rule about criminals. It began as a tool to fight serious crime, money laundering, tax evasion, drug trafficking, and other activities that governments have a legitimate interest in monitoring. But systems do not stay in their original shape. They evolve, they expand, they get connected to new technology, they become cheaper to enforce. And when a system expands while the original threshold stays frozen, ordinary people get caught in places the rule was never designed to reach. That is the real problem. The number did not move. The world moved around it. A retiree who once could manage money quietly and simply is now operating inside a financial surveillance system that is much more automated, much more sensitive, and much less forgiving than the system many people grew up with. So I want you to think of this not emotionally, but mechanically. In my experience, the best way to deal with risk is not to deny it and not to panic about it. The best way is to understand the machine, understand how the incentives work, and then behave in a way that keeps you out of unnecessary trouble. Let me begin with a woman I will call Patricia. Patricia is 71 years old. She is a retired school teacher in Ohio. She spent 35 years teaching children, doing what most people would call an honorable and steady job. She is not wealthy in the way people imagine wealth. She is careful, she has savings. She receives Social Security. She has retirement income. She knows how to stretch a dollar because she has done it for decades. Every month her Social Security payment arrives in her checking account. Every few months she moves money from savings to checking to cover something bigger than normal. Maybe it is a roof repair, maybe it is a medical bill, maybe it is a trip to see her grandchildren. Maybe it is a large insurance payment or a family expense that does not fit neatly into a normal monthly budget. In her mind, nothing about this is suspicious. It is her money. She earned it, she saved it, she paid taxes for decades. She is moving it for normal life reasons. But the system does not know Patricia as a teacher. It does not know the children she helped. It does not know the years she worked. It does not know whether she is generous or careful or honest. The system sees data, it sees deposits, it sees withdrawals, it sees patterns. And if those patterns look unusual, even if the reason is completely innocent, Patricia can become a person the system wants to examine more closely. That is the uncomfortable reality millions of seniors now face. They are not being watched because they are criminals. They are being watched because the financial system increasingly uses automated pattern recognition to decide which movements of money deserve attention. And the older you are, the more this can matter. Because retirement often creates irregular financial patterns. A worker may receive a paycheck every 2 weeks and spend it in predictable ways. A retiree may receive Social Security, pension income, IRA distributions, annuity payments, investment sales, home sale proceeds, inheritance payments, family transfers, medical reimbursements, and occasional large gifts or expenses. That pattern can look messy to software. And software does not understand your life unless you leave a clear paper trail to understand how we got here. You have to go back to the Bank Secrecy Act of 1970. That law required banks to report certain cash transactions to the federal government. The core idea was simple. If someone deposited or withdrew $10,000 or more in cash, the bank filed a currency transaction report. The purpose was to help law enforcement track money laundering, organized crime, tax evasion, and other serious problems at the time. $10,000 was a very large amount of money. It was not an ordinary household transaction. It was more than many Americans earned in a year. It was a number big enough to separate ordinary financial life from unusual financial activity. But that was 1970. The problem is that the number remained frozen over more than half a century. Inflation changed what money meant. Wages rose, housing costs rose, medical costs rose, cars became more expensive, home repairs became more expensive, retirement accounts became larger. The financial lives of ordinary people changed, but the threshold stayed at $10,000 in practical terms. The same number that once pointed mainly toward unusual activity now catches normal life events: a used car, a home repair, a medical procedure, a required retirement distribution, a gift to a child, a payment from selling property, a lump sum from an inheritance. This is how systems become dangerous without looking dramatic. Nobody has to pass a new law every week for the risk to grow. A fixed threshold in an inflating world naturally expands the number of people it touches. That is one of the great lessons of economic systems: when one variable stays fixed and everything around it moves, the practical meaning of that variable changes. The $10,000 rule is a perfect example. It may look like the same law on paper, but it does not operate the same way in the real world. There are two reporting concepts people need to understand. The first is the currency transaction report. That is the report banks file when certain cash transactions reach the reporting threshold. The second is the suspicious activity report. This is broader and more flexible. A bank may file this when it believes a customer's behavior could indicate illegal activity or an attempt to avoid reporting. This is where structuring becomes so important. Structuring means breaking up transactions into smaller amounts for the purpose of avoiding the $10,000 reporting requirement. If someone deposits $9,500 on Monday, $9,000 on Tuesday, and $8,000 on Wednesday because they do not want a report filed, that is not just a clever workaround. It can be treated as a federal crime. The dangerous part is that the money itself does not have to be dirty. It can be completely legitimate money. It can come from a home sale, retirement savings, inheritance, insurance, or ordinary business activity. The issue is the intent and the pattern. If the system believes you broke up the transactions to stay under the threshold, you may have created a much bigger problem than the report you were trying to avoid. This is where many seniors can get caught, not because they intend to break the law, but because they use habits formed in a different world. Many older Americans grew up in families that distrusted banks. Some watched parents live through hard times and learned to keep cash nearby. Some prefer smaller transactions because it feels safer. Some do not want to walk into a bank with a large sum. Some believe they are being prudent by keeping each movement under a certain amount. But in the modern system, that kind of behavior can look exactly like structuring. The machine does not know whether the person is a criminal or a cautious retiree. It only sees the pattern first. Then a human may review it, then a report may be filed. Then the information may sit in a government database, and if the facts are unclear, the burden can quickly shift from the government understanding you to you proving that your money and your pattern were legitimate. That is why documentation has become a form of financial self-defense. There have been real cases where ordinary citizens and small business owners had bank accounts seized because their deposit patterns looked like structuring. Public interest organizations have documented cases in which people had legitimate money taken even when no criminal charges were filed. They had to hire lawyers. They had to fight for their own money. Some recovered it only after long and expensive battles. The lesson is not that every person will be targeted. That is not how the system works. The lesson is that when your financial behavior looks unexplained, unusual, or intentionally designed to avoid a threshold, you become vulnerable to a process that is difficult and expensive to escape. And for a retiree on a fixed income, even a temporary freeze can be devastating. Now fast forward to 2026. The important change is not only the law itself, it is the technology around the law. The IRS and other enforcement agencies have received more resources and are using more sophisticated data systems. They can analyze information at scale. They can compare reported income against account activity. They can cross-reference data from banks, brokers, payment platforms, tax returns, and other sources. They can search for patterns that used to be too expensive or too time-consuming to find manually. This is what changes the risk. A rule that was once enforced mainly through human review becomes very different when paired with automated analysis that is true in markets. It is true in banking. It is true in government. When the cost of detection falls, enforcement expands, and that expansion hits seniors in specific ways. The first area is Social Security, pensions, and retirement distributions. Most monthly Social Security or pension deposits are not large enough by themselves to create concern. But many retirees periodically liquidate retirement assets to cover major expenses. A required minimum distribution from an IRA can easily be more than $10,000 depending on the size of the account. An annuity payment, a pension adjustment, or a partial sale of investments can create a large inflow that looks unusual if it is not matched clearly to reported income and proper documentation. The transaction itself may be completely normal, but if the tax return is confusing, incomplete, or inconsistent with the movement of money, the system may ask questions. The second area is gifts to family. Seniors often want to help children or grandchildren. They may help with tuition, a down payment, medical costs, or a first home. That is human. It is also often completely legal, but large gifts have rules, and those rules require documentation. If money is moved casually, especially in cash or in repeated smaller transfers, the system may not understand the family reason behind it. The government does not automatically know that money sent to a child was a family gift. It sees a transfer. If the amount is large enough, or if the pattern repeats, it may expect an explanation. That is why gifts should be documented clearly: date, amount, recipient, purpose, method of transfer. Any required tax filing. The more ordinary the transaction is in your life, the more important it is to make it legible to the system. The third area is home sales and inheritance. When an older person sells a home, downsizes, moves to assisted living, or relocates to be closer to family, the amounts involved can be large. Hundreds of thousands of dollars may move from escrow to a bank account. If a spouse dies, funds may move from estate accounts, insurance policies, brokerage accounts, or retirement accounts. These are normal life events, but they are also large financial events. The bigger the transaction, the more documentation matters. Closing statements, estate documents, bank records, beneficiary forms, tax forms, and written explanations are not paperwork for their own sake. They are the evidence that connects the movement of money to a legitimate life event. The fourth area is everyday senior finances. And this is where the problem becomes more subtle. A retiree may sell furniture, jewelry, a car, collectibles, or tools. A retiree may rent out a room or collect rent from a small property. A retiree may help a family member by holding money temporarily and moving it later. A retiree may receive reimbursement from relatives for shared expenses. Each event may be innocent, but when they are mixed together in one account without a clear record, the pattern can look confusing, and confusing patterns create risk. In financial systems, complexity without documentation is dangerous. Not because you did something wrong, because the person reviewing it later may not be able to see what actually happened. Now let us look at what happens mechanically when the system takes interest. When a bank files a currency transaction report or suspicious activity report, that information goes to the Financial Crimes Enforcement Network, a bureau of the Treasury Department. That information can then be accessed or shared with law enforcement agencies, including the IRS. The IRS can use analytical tools to determine whether a person or account deserves further review. That review can remain invisible, or it can become visible through a letter asking for documentation. It can become an audit. In more serious cases, it can become a criminal referral. In cases involving suspected structuring, it can create the risk of civil asset forfeiture. Civil asset forfeiture is one of the most important risks to understand because it does not work the way most people think justice works. In a criminal case, the government must prove guilt. But under civil asset forfeiture, the property itself is treated as connected to suspected wrongdoing. Once money is seized, the account holder may have to fight to get it back. The process can take months or years. It can require attorneys. It can cost more than many retirees can comfortably afford. This is why I always look at systems by asking where the burden falls. If the burden falls on the individual to explain everything after the fact, the rational response is to prepare the explanation before it is needed. That is not paranoia. That is good risk management. Now, I want to be careful and balanced here. Most transactions reported under these rules will never lead to an IRS contact. The government receives enormous amounts of data, and most of it is never acted upon. A report does not mean you are accused of a crime. It does not mean an audit is automatic. It does not mean you should be afraid to move your own money. But low probability events can still matter when the consequences are severe. A retiree does not need a high chance of a freeze, seizure, or audit for the risk to be worth managing. If the cost of a problem is high and the cost of prevention is low, you prevent it. That is the principle. So what should a senior do? The first and most important thing is to keep records. Not perfect records, clear records. If you sell a home, keep the closing statement. If you receive an inheritance, keep the estate documents and bank transfer records. If you take money from a retirement account, keep the statement showing the distribution. If you make a large gift, write down the date, amount, recipient, and reason. If you sell a car or jewelry or furniture, keep the bill of sale messages, receipts, or anything showing what happened. A transaction with documentation is an explanation. A transaction without documentation is a question. And when the IRS or a bank asks questions, you want to be able to answer with facts, not memory. Memory weakens under pressure. Documents do not. The second thing is to speak with a tax professional who understands retirement income and senior financial issues. Not all tax issues are the same. A retiree's financial life can include Social Security taxation, pensions, required minimum distributions, annuities, investment gains, inherited accounts, gifts, home sales, Medicare, related income thresholds, and estate issues. A good CPA, enrolled agent, or tax attorney can help make the overall picture clear and consistent. The purpose is not to hide anything. The purpose is to make sure legal transactions are reported in a way that the system can understand. The third thing is to avoid even the appearance of structuring. This is critical. If you need to move $18,000 for a legitimate reason, do not split it into $9,000 and $9,000. Merely because you think staying under $10,000 is safer. It is not safer, it may be more dangerous. A single properly documented transaction that triggers a report is usually far cleaner than multiple smaller transactions that look designed to avoid one. In many cases, the report itself is not the problem. The attempt to avoid the report is the problem. That is a distinction many people miss, and missing it can be costly. The fourth thing is to understand your rights. If you are contacted, if the IRS sends a letter or asks about transactions, do not panic, do not ignore it, do not make up explanations, do not handle serious matters alone. If meaningful money is involved, you have the right to representation, you have the right to respond carefully, you have the right to ask for clarity about what is being questioned. Most problems become worse when people react emotionally. Slow down. Get help, respond with documents, make the facts clear. The fifth thing is to coordinate with family. Many seniors do not manage money alone. They help children. Children help them. Grandchildren reimburse them. Relatives borrow and repay. Someone may deposit money into an account to cover expenses. Someone may help manage bills. The intent may be good, but the pattern may look bad. If money is moving between family members, write down what it is and why. Use checks or wires when amounts are significant because they create clearer records than cash. If an adult child is helping with an elderly parent's money, make sure the legal authority is correct. A power of attorney or similar document can protect both sides. Good intentions do not protect you from bad records. Clear authority and clear documentation do. The sixth thing is to stay informed. Financial rules are not static. Reporting requirements, enforcement priorities, IRS funding, audit methods, digital payment rules, and banking compliance procedures can change. Even when Congress does not dramatically rewrite a law, enforcement can change because technology changes. This is one of the realities of modern life. The system is becoming more data-driven. That means ordinary people have to become more record-driven. It may not feel fair, but understanding reality is better than resenting it. Now I want to address the emotional side because it matters. Many seniors feel insulted by these rules. They feel that after a lifetime of work, taxes, saving, and responsible behavior, the government now treats them as if they are suspicious until proven otherwise. I understand that reaction. There is a real tension between the government's interest in preventing financial crime and the individual's interest in privacy and financial freedom. That tension is not imaginary. It is built into the system. It has existed for a long time. But technology has made it more visible and more powerful. When a human banker knew the customer, context mattered. When a software system scans patterns, context comes later. That shift changes the experience of financial freedom. The best response is not to pretend the tension does not exist. The best response is to navigate it intelligently. You can believe the system is unfair and still protect yourself within it. In fact, that is often the most practical position. There is also a special issue around cognitive decline. As people get older, some financial tasks become harder. A senior may forget why a transfer happened. A family member may step in to help. Automatic payments may continue without anyone keeping a clear overview. Cash may be moved because someone is confused, pressured, or trying to solve a problem quickly. These situations create risk. If you are helping an elderly parent or grandparent, do not treat the financial process casually. Have proper legal authorization, keep detailed records, use clear payment methods. Avoid cash when large amounts are involved. Make sure every meaningful transaction has a reason attached to it in writing. This protects the senior. It also protects the helper, because if the system later asks who moved the money and why, you do not want the answer to be unclear. Another major risk is scams. Older adults are often targeted by criminals who understand how fear works. They create urgency. They create secrecy. They tell a person to move money quickly. They may ask for amounts just below $10,000. They may tell the victim not to tell family or the bank. They may coach the victim on what to say. This is dangerous in two ways. First, the senior may lose the money. Second, the transaction pattern may look suspicious after the fact. A victim of fraud can become entangled in an investigation because the movement of money resembles money laundering or structuring, even though the senior was being manipulated. That is why the rule should be simple. If anyone asks you to move money with urgency and secrecy, stop. Pressure is a warning sign. Secrecy is a warning sign. Instructions to avoid bank questions are a warning sign. Talk to a trusted family member, attorney, banker, or financial professional before acting. The speed of a scam is part of the scam. Slowing down breaks the mechanism. There is also a role for advocacy. The $10,000 threshold has not kept pace with inflation. Civil asset forfeiture remains controversial. Bank reporting rules raise genuine concerns about financial privacy. These are not fringe issues. They affect ordinary people, particularly seniors, small business owners, and families dealing with life transitions. If people believe the threshold should be indexed to inflation, they can tell elected representatives. If they believe forfeiture laws need reform, they can support organizations that work on those issues. If they believe the IRS and banks need clearer rules so innocent people are not caught by automated systems, they can make that concern known. But advocacy is slow. Protection has to happen now. The direction of travel is clear enough. Whether rules tighten or loosen at the margin, financial activity is becoming more visible. More data is collected. More analysis is automated. More systems talk to each other. The ability to monitor money is greater than it was 10 years ago. And it will likely be greater 10 years from now. That does not mean you should live in fear. It means you should live with good systems. I learned over a long period of studying markets, governments, debt cycles, human behavior, and institutions that most people get hurt not because risk appears, but because they did not prepare for risk. That was already visible. The $10,000 rule is visible. The expansion of data analysis is visible. The vulnerability of seniors is visible. The solution is also visible. Keep records, move money transparently. Do not break transactions into smaller pieces to avoid reporting. Use professionals. When the amounts matter, coordinate with family. Get legal authority when helping an older person. Be careful with scams. And treat documentation as part of managing money, not as an annoying afterthought. You worked for your money. You deserve to use it. You deserve to support your family, pay your bills, repair your home, sell your property, receive an inheritance, make gifts, and live with dignity in retirement. But in the modern financial system, deserving something is not enough. You must be able to prove what happened. That is the hard truth. Not because you are guilty, because the system is built to ask questions when money moves in ways it does not immediately understand. So the practical answer is simple. Make your money movements understandable before anyone asks. Do not wait for a letter. Do not wait for a freeze. Do not wait for a confused family member to reconstruct 5 years of transactions from memory. Build the habit now. Write things down now. Organize the documents now. Have the conversation with your family now. Talk to the tax professional before the transaction, not after the notice. The people who will be safest in this environment are not the people who never move money. That is not realistic. Life requires movement. The safest people will be the people whose money movements make sense on paper. That is what reduces fear. That is what gives you control. And that is what allows you to deal with a complicated system without becoming a victim of it. The $10,000 rule is real. The reporting system is real. The risk to seniors who do not understand it is real. But so is your ability to adapt. The system has changed. So your habits must change with it. Not because you did anything wrong. Because the cost of being misunderstood has become too high. If there is one principle I would leave you with, it is this. In a world where financial systems increasingly judge people by patterns, your job is to make the pattern clear. That is how you protect your money. That is how you protect your family. And that is how you keep control over the life you spent decades building.